Good morning, everyone. Thanks for joining us this week on our Phillip Security Research morning call for the 30th May 2022. Today, we have quite a few stock counters that we'll be discussing as well. And we also have our stock weekly for our macro sector outlook. Without further ado, I'd like to hand over the time to Ambrish to talk about Salesforce. Thank you.
Thank you, Sean, and good morning, everyone. So the research team has initiated coverage on Salesforce with the title Multi-Cloud Strategy to Fuel Revenue Growth. Next slide, please. Salesforce is a cloud-based software as a service company, basically a SaaS, which means it hosts an online application for its clients. It operates the leading customer relationship management platform that unites companies' sales, service, marketing, and IT departments, mainly to enhance existing customer relationships and boost sales. Salesforce has a subscription-based business model that runs on a pay-as-you-go basis, which means it's similar to Netflix or Amazon Prime, where you pay monthly or annually for services subscribed. Salesforce delivers services to more than 150,000 businesses globally, which includes Ford, Southwest Airlines, and T-Mobile. The company mainly breaks down its revenue into two segments. The first is subscription and support revenues, and the second is professional services and others. Subscription and support revenues are by far the largest income stream for Salesforce, as it contributed about 93% of overall revenues last year. This segment includes subscription fees that are paid by the enterprise customers for using the Salesforce cloud computing services such as Sales Cloud, Service Cloud, Marketing and Commerce, as well as revenues from software license related businesses like Tableau. So basically, Sales Cloud manages and automates sales processes. It helps companies to determine which clients might buy a new product or a service. Service Clouds help companies to deliver personalized customer service and support. Marketing and Commerce Clouds helps companies to streamline their marketing campaigns, social media and create integration, online shopping experiences, and etc. Lastly, the platform helps companies to build their own applications with the drag and drop tools. This is basically a platform as a service component for Salesforce, and also included in this segment is the workplace messaging service Slack, which Salesforce has acquired last year. Meanwhile, professional services and others includes revenue from services like consulting, training, and deployment. Salesforce generated 68% of revenue in FY22 from the Americas market and the remaining from the Europe and Asia Pacific. Next slide, please. So our first investment thesis is that Salesforce broad product portfolio serves as a competitive advantage. So basically, Salesforce CRM applications are integrated within its customer 360 platform that can be customized for each business and industry. And as a result, a particular company can get a 360-degree view of their own customers as Salesforce Customer 360 platform connects all client data. Salesforce's ability to provide a full integrated suite instead of point solutions has been a significant driver of new customer wins and expansion deals. Talking about its financials, the company's revenue has increased from about 10.5 billion in 2018 to 26.5 billion in 2022. And the significant driver was continued demand for its Customer 360 platform, new customer wins, as well as additional subscriptions from existing customers and upgrades. We have modeled a revenue growth of about 21% for FY23. Salesforce generates over 90% of its revenue from subscriptions, and the subscription revenues are basically recurring. And as a result of this, its gross margin, it has an impressive gross margin of about 74%, as they don't have to spend much on their cost of revenues. So if you want to know Salesforce future revenue growth, we should look whether Salesforce remaining performance obligation RPO is growing each year. This indicates whether the future revenue that is under contract but hasn't yet been recognized by the company. So the total remaining performance obligation, it increased by about 21% in FY22 to about $43.7 billion US. And out of this total, the current portion which the company believes that it could be recognized in the next 12 months, that portion jumped by about 22% to 22 billion, and the non-current portion was about 21.7 billion. And this is a good indication that Salesforce revenue in near term is expected to grow. Salesforce management expects its total addressable market to reach 258 billion by 2025, and the main growth drivers are acquisitions like Slack, MuleSoft, Tableau, internal innovations, and organic growth from acceleration and digital transformation spending. Next slide, please. So our second investment thesis is that Salesforce continues to innovate its Sales Cloud offering. Sales Cloud automates and expedites sales processes from leads to opportunities to billing, and it is the company's most matured solution. Sales Cloud contributed close to about 6 billion in subscription revenues for Salesforce, and it grew by about 15% year over year in FY22 and comprises about 24% of the overall subscription revenues. And this growth was mainly because the company introduced innovative features such as subscription management, revenue intelligence, and sales enablement. So on the right-hand side, it's just for the knowledge that Sales Cloud dashboard, how it appears, and the multiple metrics that we can see that there is an average sales cycle of a company, win rate, the open opportunities that the company have right now, whether a particular lead or opportunity is from a new customer or an existing customer, and so on. So we expect Sales Cloud revenues to grow by 16% year on year in FY23 as businesses rethink their sales process. With a focus on the long term, we believe Salesforce Sales Cloud can sustain double-digit growth with upselling and new solution offerings contributing to growth. Next slide, please. Our third investment thesis is that multi-cloud adoption is key to expansion. Salesforce multi-cloud strategy allows integration across its cloud applications, and as a result, Salesforce can better monetize its customer base and increase potential revenue per user. On the right-hand side, we can see that Salesforce multi-cloud customers, they accounted for about 95% of annual recurring revenue in FY22, while just 5% of the annual recurring revenue came from single cloud users, which is compared to 92% multi-cloud users and 8% from single customers in FY 2020. This highlights that the integrated platform-based value proposition is resonating well with customers. So for the 79% of incremental annualized revenue came from existing customers and 21% from new customers. This was mainly because the company was able to cross-sell more clouds to the existing customer base. And as a result, the software company's effective cross-trailing strategy has enabled to offer it as many as 7 clouds to a particular customer. On the left-hand side, we can see that the ARR from 4 or more clouds has increased by 3 times since FY18, and the ARR from 6 or more clouds has increased by 97 times since FY18. And additionally, it has a low attrition rate. It finished FY22 by about between 7 to 7.5%, and this suggests that it's retaining a major chunk of its customers. We believe there is still opportunity for Salesforce to expand within its existing client base, and increased multi-cloud adoption will be a major driver of expansion. Next slide, please. We value Salesforce at $258 based on DCF valuation using a 6.1% weighted average cost of capital and 4% terminal growth rate. So overall, Salesforce generated strong free cash flow of about 5.3 billion in 22. And this was mainly fueled by strong demand for its customer 360 platform, high recurring subscription revenues, as well as the company benefited from higher switching costs and a robust competitive performance. Yeah. I would now like to pass on to Jonathan for OIO Holdings and TDCX updates. Thank you.
Thanks, Ambrish, and good morning, everyone. So today I'll be sharing on TDCX's first quarter 2022 results. And the report is titled Accelerating Client Additions. Next, please. So Overall, TDCX's first quarter revenue and PATMI was at 22% and 17% of our forecast. PATMI kind of underperformed quite a bit, and this was mainly due to a higher than expected employee benefits expense and tax rate. So for the quarter, the company recorded 152 million Sing dollars in revenue, with 22.3 million in PATMI and 15 cents EPS. On the positives, they had a higher than expected revenue growth for the quarter. So their revenue grew 27% year on year versus our estimates of about 25%. And this was mainly driven by increases in sales and digital marketing, which grew 60%, and omnichannel CX, which grew about 25%. We do expect this to continue moving forward as more companies turn to outsource specialized services like TDCX. Revenue from new economy clients remained at around 93%, so very similar to the fourth quarter of 2021. The company also added 10 new client additions for the quarter, which is more than double that they did in the first quarter of 2021. And a couple of these clients include a global leading short-form video platform and a leading Southeast Asian e-commerce platform. So the company's TDCX started partnerships with these platforms with offices in Singapore and Barcelona for the short-form video platform and offices in Malaysia for the e-commerce platform. And they intend to serve both clients across both omnichannel CX and digital marketing, sales and digital marketing services. On the negatives, there was a sharp decline in margins due to an increase in equity share payments, which they lump into their employee benefits expense. So this is basically their share, or rather performance share plan. You can see the employees benefits expense jumped 39% year on year, and this is mainly because this PSP or share payments was only introduced towards the end of last year, so they didn't have it in the first quarter of 2021, and that led to operating margin decreasing from 27.6% to about 21%. So the company also reduced their full year 2022 revenue guidance to a range of 650 to 675 million Sing dollars, which was a 5% decrease in guidance. And the management stated the main reason for this was a continued uncertain macroeconomic environment, so very much in line with a lot of the other big tech companies and a lot of new economy clients. If you take the midpoint of this guidance, it represents about a 19% year-on-year increase. So for the outlook, a continued weak macroeconomic environment should affect growth moving forward. So it should slow down growth a little bit. We expect growth in content moderation to remain fairly stable. We expect omnichannel CX, which is their largest revenue contributor, to be the most affected due to overall slowdown in business activity. Sales and digital marketing, on the other hand, is expected to continue expanding due to the increasing demand for its services. And one of the reasons for this is that because TDCX acts as like a proxy for its, or rather it acts as a specialized service for its clients, we can see more and more clients are turning to them and its competitors in general to kind of maximize their marketing budgets, especially with the slowdown in revenue growth. So for valuation, we reduced our full year 2022 revenue by 5%, and we cut our PATMI by 33% on contracting margins. We do maintain a buy with a lower target price of $15.76, down from our previous target price of $22. And we have a WACC of 9.7% and a terminal growth rate of 3%. So that's all for TDCX. I'll now move into OIO Holdings. We did a Phillip on the ground. We're doing a Phillip on the ground for OIO Holdings. So OIO Holdings is, just to reiterate, it's a non-rated company. So they began as a M&E engineering company, a mechanical and electrical engineering company, but have recently pivoted towards and are focusing most of its efforts now in its blockchain services. So in terms of blockchain services, what they provide is staking services, asset management, and blockchain consulting. Just a little bit of background on staking, like what is staking. So staking is essentially a crypto staking, rather, is essentially when a person, it could be an individual or a group of people, they agree to lock up a certain amount of crypto in exchange for the chance to validate the new blocks on the blockchain. And this is done where the blockchain algorithms select validators to be able to have the chance to validate these blocks, and in return they get just like staking rewards. So if you think about it from a traditional finance standpoint, it's simply interest income. So like I pledge or I lock away, let's say in this term of crypto, I lock away like one Cardano, for example, to use for staking, and I receive X amount of yield, maybe 4 or 5% annual yield in return. So there are a few types of staking. One which there are three types of stakings mainly. The first would be proof of stake, which is what OIO Holdings is participating in. Then there's another kind of staking called smart contract staking, which is what Luna, the whole Terra Luna situation is kind of going off on. And the last part of staking, or rather the last type of staking, is deposit staking. So this is staking that is generally offered from your exchanges, your crypto exchanges like Coinbase and Gemini, where there's not much. So for smart contract staking and deposit staking, there's really not much fundamentals behind it, and it's very gray. So for the deposit staking, it's essentially like it's really just deposits. You put money in there, or you put crypto assets in there, and the company, for example, Coinbase, it promises you an 8% return, but but you don't really know what goes on behind the scenes. What they do to generate the 8% is not disclosed. And so what OIO is doing is, or rather what they're focusing on, is their proof of stake. So there's quite a significant, or rather a more legitimate background to it and fundamentals to it. They recently acquired a company called Moonstake.io in 31st May of last year, and this is their main crypto product. So it's a proof of stake validator and wallet. It mainly targets your B2C clients, so like maybe you and me, people who are in the know of crypto, or are actively already participating in crypto. And how they generate revenue is just from commissions. So if you look at the whole kind of staking mechanism, people put your crypto, for example, one Cardano, they'll put it into this treasury pool. Or even if there's no treasury pool, let's say you in the whole, just for example, if there's the whole blockchain network of Cardano, there's only about 10 Cardano coins. If you have one coin that's about 10% of the whole market, you put this money into a staking, or rather you stake this money, and the algorithms behind the blockchain calculate that you have about a 10% probability of obtaining the obtaining the rewards from effectively validating a block of blockchain on their blockchain. So as you put your money to work, you basically stake your money. Every time it validates a blockchain, you get your let's say 3.5% or 4% or whatever on your one Cardano, and you get it back returned to you. And how OIO makes money from this is that they take a commission of about 2.5% of your yield, so of your 5% or 4% or whatever. And some of their I guess their main growth strategy would be to increase the TVL, which is the total value of assets blocked, which is essentially your treasury pool. So the bigger the treasury pool grows, obviously the higher the returns are in the quantum, and obviously they generate more money because they take a fixed commission off all of that. Another way they are planning to increase their revenue stream is by adding new validators. So adding new treasury pools that focus on different kind of crypto coins. So right now they have about, I think, 15 to 20 crypto coins, and most of their assets right now are actually in Cardano. They also have other other coins. I believe usually most of them are like your altcoins. So they don't hold any of the two main coins in Bitcoin and Ethereum as of right now. So on to the second business, it's OIO Singapore, which is their asset management and blockchain consulting business. In terms of blockchain consulting, the management has also told us that this is actually taking a backseat. They're not really focusing on it because of the use cases. It's not as effective on a company level as it is on a government level. And so they're focusing mainly on their asset management business, which is targeting B2B clients like institutional clients, family offices, etc. And how it works is that they target these institutions that want to have exposure to crypto but may not have the know-how into doing it. So they would essentially they act like a consulting firm. They charge a consulting fee and commissions as well. Currently, they have about $2.5 million US dollars worth of assets under quote unquote management. One of the reasons why I say this is because they don't hold any coins in custody, but this AUM number is just basically a number that they take from the kind of assets that their clients have under them. So their last product, which is Upwards, is their new platform that they are planning to roll out. It's an asset management platform, and it's their first custody product actually. It's targeted towards B2C clients, mainly crypto beginners, who are also small volume users. And the main way they generate revenue is from commissions as well. If you think about an AM platform, it would be similar to your robo-advisors like Syfe, Stashaway, and Endow.us, things like that. And it's something that they are planning to roll out, I believe, in the third or fourth quarter of this year. So in terms of overall growth strategy, obviously the first one would be to grow your user base, given most of their income is from subscriptions, right? So very similar to companies like Netflix. And right now they are predominantly in Japan, so they're trying to expand out into new markets in Asia and Africa. The other way they're planning to grow their business is to growing their revenue per user. They're trying to do this by cross-selling services. So, for example, when they do their asset management consulting for a family office who wants to stake, let's say they've got like 10 Cardano or they want to stake it, but they don't know how. So then obviously OIO would recommend using moonstake.io to stake for the family office to stake their crypto coins. So essentially it's just cross-selling services because you earn your management consulting fee, and at the same time Moonstake will earn revenue from commissions. So if you look at the chart on the right, this is for full year 2021 and 2022. Revenue grew 240%. And this is largely because they started ramping up their crypto blockchain services. However, net loss also grew about 23%. And one of the interesting things about this company is that their company value is quite closely related to the value of crypto. So, for example, I believe about 80+% of their holdings are in Cardano. And so if your Cardano price drops 10%, then generally you'll see a company's value drop similarly about 10%. And so that's all for OIO Holdings. I will now pass my time on to Terence, I believe, for Metro Holdings. Thank you.
Hey, yeah, thanks, Jonathan. Hi. Sorry. Yeah, so we met with Metro Holdings. This is our Phillip on the ground, Metro Holdings. In our next slide, financial year 22, summary for Metro Holdings, NOPAT came in at $23.7 million versus the $37 million in FY21. The lower NOPAT was dragged down by impairment loss of $36.3 million due from associates, namely Bentall Green Oak, due to the ongoing China property sector headwinds. This along with lower contributions from the Crest, which is a property development in Singapore, and higher rental rebates and waivers granted to tenants arising from COVID-19 lockdowns also dragged earnings. Investments in China lightened due to headwinds, but the group continued to invest across its key markets like Australia through a mixture of shopping centers, offices, and retail centers. In Singapore, they invested in a high-spec industrial property at 351 Braddell Road, and in Japan through their cornerstone investment in Daiwa House Logistics Trust IPO. In terms of the outlook, the group remains optimistic in its property investments business in their key markets, namely Singapore, China, Indonesia, the UK, and Australia as well. In China, the outlook continues to remain a little bit cloudy, but they continue to be looking for opportunities there and are confident in its recovery. They will continue to seek out opportunities in its key markets, and this is possible because of its sizable balance sheet with net assets of $1.6 billion. So that's all for me for Metro Holdings. I'll now hand over the time to Vivian.
Thanks, Terence. For the next counter would be also a Phillip on the ground for Valuetronics second half 22 results briefing. And just to note, we do not have any coverage on them. So for Valuetronics, they do design and manufacturing for customers in two main segments, consumer electronics and industrial and commercial electronics. So you have the CE and ICE. For the production facilities, they have two, one in Daya Bay in Guangdong and also Vietnam, which just commenced mass production in the fourth quarter of FY22. Zooming into the second half 22 results on the segments. So for the revenue, we do see that the revenue dropped by around 15% for second half. The drag came mainly from the ICE segment, which was due to its automotive customer that shifted to another vendor in North America. And on the CE segment, we see a 22% increase. This is mainly due to increased orders from the smart lighting customer, but the rebound is not expected to continue as mentioned by the management, with lower customer forecasts and also continued components shortage issues. For the automotive customer under the ICE segment that shifted to another vendor in North America, if you refer to the chart on the bottom right, the proportion of revenue from North America was down from 43% to now about 37%. And this is the result of the US-China trade war. And on the margins, they were also down due to higher component prices and China's increased labor and operating costs. On the Shenzhen factory, on the next point, the regular COVID testing that they had to do still hampered their production. But as mentioned, the situation remains very fluid due to China's now dynamic zero COVID policy. But on the lead times, they are still very long due to the lockdowns, which have made it very hard to move the imported components. So supply chain disruptions is still an issue. On the new factory in Vietnam, they just commenced the commercial production in fourth quarter as mentioned, but this is still in very early stages. If we are looking at the capacity in terms of land area, then if comparing land area of 52,000 square meters in Vietnam, that would be around 50% increase. But of course, this would take time to ramp up. Lastly, for the outlook, the commencement of the mass production in Vietnam for 3 customers proves a very positive start. These are new generation products which they are working with their customers for the design and development. However, even though demand for the ICE segment remains very strong, the continued components shortage and also the uncertain COVID situation in China could continue to hamper growth. So that's all for Valuetronics. I'll now be passing the time on to Paul.
Yeah, thanks, Vivian. Move on to Netlink's fourth quarter results. Stable dividends but limited growth. Yeah. Okay, next. So in terms of the results, it was more or less in line. if you look at the dividends in the second half, it basically flat. I mean, 0.8%. It's hardly any growth. The positives was residential. So why is residential important for Netlink? Because you can see from the table on the left, most of the revenue comes from residential fiber, basically to households like us. So that has started to recover, and even that also is probably like a 2% growth. We are looking at maybe 25,000 to 26,000 kind of annualized run rate, basically the number of households or per year in Singapore. So that's where the growth is. But again, you're talking about maybe 2-3% growth only. In terms of the negatives, if you look at the table on the left, the one that's declining is the ducts and manhole. So this is mainly they rent ducts to Singtel for their copper fiber for Singtel to lay the copper fiber, and that is going to be structurally declining because everyone's moving to fiber and you hardly use any copper, so that will continue to shrink. In terms of the outlook, I think the main thing for Netlink for this FY23 will be the regulatory review. So just to give a bit of background, so every 5 years, the last time they did it was in 2017. Every 5 years, the authorities will double check will review the tariffs. That means the charges that all of us have to pay to Netlink all the fiber connections. So they will check every 5 years, and then they'll see, okay, what is the WACC? That means what should be your expected return, and then they'll look at the regulated base. Basically, that is your amount of capital you injected, and then how much return you're supposed to get. Then they look at how many subscribers you have, and then they will come up with the price for the next 5 years from 2023 to 2028. Like, what is the next price? So for us, there's a lot of moving parts. It's very hard to kind of make even a guess because there's no numbers disclosed. But we are assuming the household fiber charges that Netlink collects will be flat. So that's our assumption. Some of the moving parts, I mean, if you want to get into the weeds of it, is that the regulated asset base, that means the capital they injected is higher. So of course the rate should be higher because you're assuming 7% WACC on the higher capital. Then since you injected so much capital, you earn more for the next 5 years. But the problem is that the issue you have right now would be the ability the issue you have would be, apart from the regulated asset base, the issue is that your WACC has come off. And so I can go back to the slide. The offset will be the WACC has come down because interest rates are lower, and also you got more subscribers, so you cannot charge as high. But in general, we're just expecting it to be flat. In terms of our view on this stock, so we kept our forecast intact. We expect distribution to be stable or flat, but that is the issue right now because Netlink will look and sound like a bond because they're just going to give you 5% and there'll be minimal growth. So the attractiveness we think will diminish as interest rates continue to climb. So that's our view. But of course, the value for Netlink is just a place to hide out. It's more like a bond proxy these days because they will just continue to pay stable rates. But for us, we just think that with rising rates, it's becoming less of an attractive equity for us. I mean, the investment merits kind of diminish when interest rates are higher. Next slide. Let's move on to Singtel's results that came out on Friday. So for Singtel, the results was more or less in line. The EBITDA was a bit lower, but because they got this very lumpy NBN migration earnings. So what this means is it's basically like a Netlink. So what has happened in Australia also had this Netlink whereby Optus or Singtel in Australia, they were laying all these copper cables, but then the authorities say no, everybody moved to fiber, just like us. But as a result, we will compensate you. So Optus or Singtel has been receiving this compensation, but it's continued to decline. And that's why you get these lumpy earnings. That's why when we say NBN, is this one-off payment they get, like, I think 100 million they got it. They got 100 million in 2021, but I think it dropped to maybe 60 plus million in 2022. So because of that, you're going to get a bit of volatility in the numbers. So in terms of the positives is that the earnings in Australia continue to do well. If you look at the table on the left, the Australia consumer EBITDA, although it's minus, but if you strip out the NBN, the volatile NBN, the EBITDA was actually up 8%. Most of it comes from their mobile business that we have seen prices and volume growth, which is quite rare. And what is happening is that their mobile plans is getting more traction because of the product features and so forth. The other thing that did well for Singtel is Bharti, which is their India associate. So if you look at the table on the left, Bharti from a loss of 9 million jumped to 148 million profit. This pat me. So you can see this huge jump is because in India, the price competitiveness has kind of been removed. So that's why you can see both a 23% rise in ARPU, which is selling price, and also a 12% increase in 4G subscribers. Because they are transitioning from 3G to 4G in India, and 4G, of course, you get more data bandwidth, and you should get higher margins from them. The other one that's doing well for Bharti also is their African subsidiary, which is also growing 24% subscribers and also pricing. The negative is their enterprise. If you look on the table on the left again, the group enterprise is down 4%. So that is reliant on business spending, and the biggest drag there is actually voice, ironically. So the customers they serve, like businesses that they are using less and less voice, which is obvious, fixed voice. So as a result of this is going to be a structural headwind for them in the next at least 1 to 2 years, because I don't think many people are using voice for their business use. So in terms of the outlook, we think FY23 will be a recovery and a growth year for Singtel. Firstly, you're going to get roaming revenue. So roaming revenue is a pure profit business. Roaming revenue can be maybe 20% of revenue, and all of it is profit because there's hardly any cost. So it will not only benefit the Singapore consumer, you will also benefit the enterprise, because your enterprise customers or business users that do roaming. So that will be the one growth area. The other is NCS, which I think eventually they want to IPO NCS, but that will be maybe 1 or 2 years term. But they're making a lot of acquisitions in Australia, so that will also add growth. The other thing will be emerging markets. So as emerging markets come out of lockdown, like Thailand, Philippines, and Indonesia, this will be helpful for their associates. So you look at the table on the left again, Telkomsel is Indonesia, AIS is Thailand. So all this will recover because in these emerging markets, which mainly use prepaid, telco spending is a bit more discretionary. So if your income levels improve, you tend to spend more. It's not like us here, it's almost like a utility. So over there, there's a bit more impact when incomes are higher, so you can spend more. So that will also be another tailwind for Singtel. And the other is also, of course, India, the improving prices and also rising data traffic and customers in India. So that will keep the momentum going. The other thing that can also help the share price, which is in our report, I didn't put it here, is also restructuring. So Singtel is looking to restructure, basically monetize 3 billion of assets. One of it, the big one, will probably be Com Center, which is in Orchard Road. So they will probably redevelop it, and they will still have the office there, but sell some property. Usually they will play around with this 60-40 thing because you want to avoid ABSD, right? So you have 60% commercial and then 40% residential. So that will be one way that they can crystallize value in the Com Center. And the other thing they want to do is also sell off Amobi, which kind of lost lots of money. That is probably their digital marketing mistake that they make. So they're going to sell that. There's probably around 300 million, and the rest of it, although it came out in the press that they might sell a stake in Bharti, but we still think they might sell a small stake in Bharti because they have this. They want to try to monetize or crystallize the value. So you look at Singtel's valuation. If you look at here, $1.15, that actually comes from Singapore and Australia. The rest of it, almost 2/3 of it, comes from associates, which is like Bharti and so. So they just want to crystallize a bit of value, and at least just show that don't have to put so much discount on the sum of parts. Because most of us will apply some discount because if it's always there, but you can't really monetize. But so they might sell a bit. We still think they might sell a bit of Bharti just to crystallize some value and get some returns, and not most of it just be like paper gains. Because most of us are just mark to market Bharti in order to the share price. Next slide. Okay, next we just go through the usual updates. Okay, so in terms of the macro news, actually some of the macro news in Singapore generally were positive. We have industrial production. I think like what was picked up in the press, what we're seeing now is manufacturing activity in Singapore is kind of broadened out now to transportation and also aerospace. So that is helping lift the industrial production or manufacturing activity. So this is a positive development. So even if you assume global growth slows down, maybe electronics will be a bit slower, but there are other pockets of manufacturing in Singapore that can pick up, which is aerospace and general transportation. The other positive was RevPAR. So RevPAR is just a fancy term for revenue per available room. So you just think of it as revenue of a hotel, because they will take the room rate, maybe $100, then assuming occupancy is 90, then or RevPAR 90. So let's assume this is revenue for a hotel. So it was up a huge 70%. I think you're getting the first month of reopening of borders, so you're beginning to feel it. So you can see how the strength in the rebound for hotel room rates. And you will see it's still 30% below pandemic. So you can see you should still expect a growth in the RevPAR or revenues for hotels in Singapore. The other two pieces of news that I guess kind of helped the market recover in the US was inflation. So-called PCE is basically inflation, personal consumption expenditure, but this is the one that the Fed likes to use because it's a bit broader. This one will include like healthcare expenditure and so forth. So it's a bit broader than the CPI that you normally read in the newspaper. So for this, it's up 5%. Slightly lower than the March number, but it's still above the Federal Reserve target of 2%. And also, so the market might be interpreting this as possible peak in inflation. But what we do know that month on month is still rising, but we'll discuss a bit later. The other thing that probably helped the market was the Fed meeting minutes. So the Fed had their meeting in 3rd or 4th May. Then the minutes came out last week, and I guess the market was just relieved that there was no plan to raise 75 basis points. So what in the minutes said that the Federal Reserve officials said that they will probably raise 50 basis points for the next couple of meetings. And the other also important thing is that they might raise it up to the end of this year and then pause a little bit. So because they want to assess the effects of after raising so many times, they just want to pause a bit. They might want to pause and then gauge how the economy is adapting to the higher interest rates. So this might be a positive news for the market, and the market could rally if, let's say, the November meeting, the Federal Reserve said that, oh, okay, I think we raised quite a lot, let's hold on for a while. I mean, hopefully that is the case, but if that happens, then the market might rally, because then you know that the Fed is not going to continue to raise interest rates. They want to assess the economic conditions. In terms of a tactical view, we still like the reopening theme. As we saw earlier, the RevPAR can jump quite significantly. And do note that the bigger boom is coming. I mean, hopefully may not be in the next few months, but by end of the year, if China does reopen the borders, and if that news happens, then you could see a lot of the reopening stocks run. And just as a reminder, China's their outbound tourism is 250 billion, and their departure in 2019 was 154 million. So if they do announce a reopening, which I have no idea when the exact date is, but assuming end of this year, then you could see a big run for the reopening stocks, because this will be a blockbuster reopening. Everyone will be, a lot of Chinese tourists will be rushing out. And you're going to, if you think airline tickets were expensive, I think once the reopening happens, I can just imagine how expensive everything will be, because they'll be all rushing out, I guess. The other thing is there's a relief rally. We'll just 1 or 2 charts later, but the key thing is it's not about whether inflation has peaked, which more or less the market has expected, but now the market is monitoring whether will they just plateau. That means inflation may run high, but after it will not come, it may come down a little bit, but it will just be at high level. So the worry is that if the PCE, like we mentioned above, will continue to be above the 2%, maybe 3 or 4%, then it may make the Fed need to keep on raising rates more, because they need to have at least a real interest rate. So we think this relief rally could run until maybe the peak, until earnings season, because once the earnings season come out, I think a lot of investors will be wary because of what has happened in the March quarter earnings season, where some stocks, if they disappoint, can collapse almost 30-40%. So they might make investors a bit more wary as they enter the second quarter earnings season. In terms of the events, the one to note for is on the 1st June, we will have a Property Guru. doing a webinar now. So if you have time now, do sign up for it. And we also have LHN Logistics and LHN. Next slide. Okay, we just wanted to show this. Actually, I just wanted to keep track myself. So just as a reminder, so this is the chart of Nasdaq during the .com. So when during the .com, if you look at the peak, was probably in end 1999 to the trough, the Nasdaq dropped almost 80% in the low of 2002. But in between, you can get very strong rallies. Of course, depending how lucky or how good your timing is. But the rallies, counter trend rallies, can range from 20% to almost 40%. So even though we're in a bear market, there is some opportunities like this. If your timing is, if you're lucky to get the timing right. But again, just as a refresh for everyone. Next slide. So for the current decline, this is the Nasdaq again. So from 2019 to current, so you can see that the last time the Nasdaq dropped 30% was when there was recession fears when the pandemic struck. We are also experiencing such a decline, but maybe not so sharp and not so fast. If there is a counter trend rally, if you look at the past 1-2 years, they normally range up to mid-teens. So the current run-up in rebound in Nasdaq is up 10%. So again, this 99% guesswork. So the rebound could maybe rebound up to another 5%. If you look at the past rallies, they all hit 14, 15, 16%. So this rebound in Nasdaq could go up maybe another 5% or so. Again, this is probably all guesswork, but just looking at the past few relief rallies, just for everyone's information. So there's another 5% is possible. Next slide. So this is my last one on Phillip on the ground. So this is Japan's food. So if you want to know how F&B operator how are the conditions for F&B operator, I guess we'll just kind of brief you on this one. So Japan Food is probably the largest operator of Japanese restaurants in Singapore. So they got like 56 stores, shops. Most of it is Ajisen. Not all, but the largest one is Ajisen. So the results were strong. If you look at the table, you can see like almost 50% jump in earnings. But do note that half of it comes from rental support, rental concessions. So the underlying business is still big. But again, this is up to March. So the meaningful reopening only happened in April. So you don't really see the reopening yet. In terms of what they're doing, so they are raising prices. So they raised the price in Ajisen by 6-7%. But the curious thing is, what they do is the lowest price item, I think it's $7.90. They won't touch that. So at least the consumer, when they come in, they look at the lowest price item. Oh, price hasn't changed. But the other things in the menu were up, at least $1. Just for info. In terms of store performance, the suburban stores are recovered back to pre-pandemic, but the ones that are still affected is like Vivo City, where you still need tourist arrivals. So without tourists, they will still be below pre-pandemic levels. And also Bugis City Hall still affected by not everyone going back to office yet. So this is the operating conditions. Someone asked about chicken. If you want to know, but if you are interested, they only import chicken bones from Malaysia. If anybody wants to know. Most of the meat all comes from Brazil. They can even take it from Thailand or Argentina. So it won't be will badly affect them. Rental, I think they said best case they hope is just a low single-digit rise. So the mall operators still have very strong bargaining power. In terms of the expansion, or let me just go to the outlook. So for them, the problem with Japanese food concept is that there's very little loyalty. So they keep on open, close food concepts. So you can open the first year, do well because a lot of customers will rush in because of the novelty. Then the second year, more or less, they're going to close it because then the novelty wanes and people are not interested to go to the restaurant. So, but what they found is that for halal food, Japanese food, where there's probably less competition, they seem to have better brand loyalty. So for them, all their growth will be channeled on halal Japanese food. So they're just going to open, out of the 7, 5 will be halal Japanese food. Yeah, because that one, they see the loyalty tends to be stickier. Okay, I think anyway, just for everyone's info, if you want to know what's going on in the F&B. Okay, I think that's it for me. I think we can move on to Q&A.
Yeah, I think I'll take the first question. Hi, Terence and Paul, and maybe Paul can chime in also. What is the latest on the merger of Keppel O&M and Sembcorp Marine? There are a few questions, so let's take them in rolling order. In terms of the current status for the merger of Keppel O&M and Sembcorp Marine, they are currently going through, they need to obtain regulatory approvals and antitrust approvals because both of them operate in multiple jurisdictions around the world. So these approvals will take time. We estimate that it will take anywhere between 3 to 5 months for them to obtain all the regulatory approvals for both Keppel O&M and Sembcorp Marine. In terms of what's after they've obtained all the regulatory approvals, then they will have to go to obtain EGM approval from their respective shareholders. Expected no change in the expected completion of the timeline. They still expect to complete the merger of both entities in the fourth quarter of 2022. Can you give us a sense of the global O&M business and what are the future prospect in these sectors rather? So in terms of the global O&M business, it has been very, very strong, supported by high oil prices. Most of the oil players, what they've seen, O&M players, what they've seen is an uptick in terms of not just the contracts in the new areas, in terms of their order books ticking up, but they also see some of the rates also starting to pick up in this sector. But having said that, it's not like the oil capex majors are ramping up their capex spending, because there are still a lot of idle rigs that have been left there, and they're still waiting to look at whether the oil prices can sustain. We'll touch more on the future prospects slightly later. So the ramp up from some of these major capex, oil majors have been quite subdued, even if it has increased. In terms of the future prospect in the sector, the International Energy Authority (IEA) actually forecasts oil prices to remain stable for 2022 and 2023. Beyond that, it's a little bit hard to forecast. With oil price surging, is it time to start accumulating O&M related equities? Example, Yangtze-Jiang, Dynamac, ASL. What are the good signs to look out for, whether to start taking position or stay out of it? So we don't cover these companies like Dynamac or ASL Marine, but the way we would think about it is, you want to get exposure to the larger O&M players, because even though the oil prices have gone up, and that has been supportive for the industry, but the sector still remains challenging, and that's the reason why Keppel O&M and Sembcorp Marine are actually merging. So if you want exposure, then you should look for those big players that can take advantage of these opportunities in terms of skill and also technological advances, technological capabilities as well rather. Yeah, I'm not sure if Paul has anything to add, so let's leave this question here. Yeah, I think that's all from me. I'll hand over the time to the rest of my colleagues.
Yeah, I'm not sure, Terence. There is I guess the worry we have. Sorry, I was doing something. Is that Sembcorp, when they issue the shares to Keppel, will be given 8 cents, right? Is the valuations at 8 cents? So I think that will be we worry that can be an overhang. I mean, if the deal goes through, yeah, that this 8 cents will be given to a lot of Keppel Corp shareholders, minority shareholders. Yeah, have I got it right? I can't.
Yeah, correct. That's right.
Yeah. So that's the worry we have. I think if the deal goes through, then there could be a large float of shares at 8 cents. And I know it's not really free for the Keppel Corp shareholders, but on paper it looks like free. So we just worry that once this deal goes through, there'll be a bit of overhang for Sembcorp Marine shares. In terms of like what Terence mentioned, in terms of the capex, the problem is that a lot of the capex hasn't really totally recovered. There's a lot of cancellations. Even CSC also mentioned that some of the FIDs can be cancelled. So I think with the renewables, the capex spend for oil and gas majors it's not as we expected. So although you say the oil price is up, but you must think of the volatility. Year 2000, the oil price was 0, then now up to 100. So when they're taking a 5-year plan, they also they also get worried the oil price is very volatile in the longer term. So that's why we even see a huge jump in what they call it, capex spend. Yeah, okay, thanks. Yeah, I'm not sure if I really added anything. Okay, of the three telcos, which one is the cheapest and which one is the best position for growth? I think for me, if you want to play roaming revenue, it will be StarHub. I think StarHub will be the best position, and they give you, I think, a 4 or 5% yield. So I think StarHub would look the cheapest, because I think if like we mentioned before, almost 50% of the profits actually can come from roaming. And I think they could do some aggressive moves in the digital entertainment. We speculate that they could come up one app that will have Netflix, all the they want to do like a super app for entertainment. English Premier League, Netlink, Netflix, and everything all combined into one app itself. So we think that could be quite a strong move into digital entertainment. Yeah, and anyway, regardless, they're going to get a tailwind, because we cannot be precise on the timing because we still don't have the Chinese tourists. But when Malaysia reopened, I think 1/3 of the roaming comes from Malaysia. I mean, roughly, so they will still get this benefit. Yeah. And I think no one can actually kind of know. And I don't think hardly any analyst will know how much to factor this in, because the timing is also unclear. Yeah. Would digital banking license award has any positive impact on earnings or Singtel for this year? Actually, this was a question posed. I mean, for those who are interested in the Q&A, someone did ask about the digital banking license. They flatly outright say that it will have not much impact on them. If I'm not mistaken, I think correct me if I'm wrong, Glenn, but the digital license requirements on the first 1-2 years, the amount of deposits you can collect, I think it's only 50 million. And plus your capital, your loan book, I'm not sure how much can your loan book be. Maybe 50, 60 million. There's like, I don't know, 10, 20 housing loans, and then you cannot lend out any more money. Your deposits are gone. So we think the impact on digital banks in general won't be that significant. But for Singtel, they are going for a regional play on they're going for a regional play on digital banking, because for Singtel, sitting under the Singapore license, there will be Indonesia under the Indonesian bank that they bought, and also for digital banking, and they will also have Malaysia. So it's a bit more interesting as a regional play, and then maybe eventually they'll spin it off. But I don't think in terms of the impact to the share price won't be so meaningful. It probably take 2 to 3 years. We need to see how well they're doing, what's the growth like, and so forth, before you can ascribe any value. But the next 1-2 years, pure speculation, because we do not know the numbers. We don't know how much profit they can make, how much revenue they can make. Yeah. Okay. Yeah, sorry, it's a long answer again. What's your advice to take up? I thought the offer was, sorry, I need to double check on this. But I would have assumed the yeah, you mean the offer? Yeah. I think I wouldn't, for me, I think I would still stick to. I would rather not take it out in my own view. I know what you're referring to, because the offer price is at the current price now, because they made a offer, mandatory general offer. I think that again, it depends on everyone's view, because SPH REIT is basically an Orchard Mall, and if you think there's still room for the rental to grow, because when tourism come back, then I'm not sure if selling it now when you haven't got this rebound in tourism in Singapore would be a good idea. Again, this is just a general view. Because I think there probably still be upside when the borders reopen, when Orchard Road is reopened and more tourists come in. So the last briefing, if I recall, SPH REIT is starting to recover. So maybe selling it now would be a bit. Again, we don't have coverage, maybe a bit premature to take the offer now. And also now under Cascaden, who knows, Cascaden has other assets to inject into SPH REIT. Yeah. Again, this is all just our own view. I guess Cascaden should be a stronger parent, I guess, right now. since you have hotel properties behind them, and also you have, I guess, some Temasek linked companies. Yeah. So maybe a bit premature, I mean, just to answer your question, because the recovery hasn't really maybe not been priced in yet for SPH. Okay, I think I don't see we have any more questions. So thanks everyone for your time. Yeah, we noted on the acronyms I see on the chat side. So we will, in future when we present, we will also try to explain a bit more on the acronyms because not everyone will be familiar with it. Yeah, apologies for that. So with that, I'd like to thank everyone for your time and for all your questions. Hope to see you